Welcome to Up the Stock Market Learning. The beginning is most important. In this video, we are going to discuss about what is dividend, what are the type of dividends in the stock market, how often are the dividend distributed to the shareholders, what is a dividend yield, and how to calculate the dividend yield. We can check the high quality dividend paying stock in the stock market. We can see what are the important dividend dates, why the company pay dividends, the advantages of the dividend investing, the risks involved. In short, we talk about the taxation and the TDS on your dividend income. For many investors, the dividend stock offer the best of the two worlds, the healthy balance of a risk and the return. Investors receive the benefit of both, the share price appreciation and the ability to realize the profit through the dividends without having to sell the shares. Moving on to the topic number 1. What are the dividends? A dividend is a share of profit and retained earning that the company pay out to its shareholder and the owners. When a company generates a profit and accumulate the retained earning, those earnings can be either reinvested in the business or paid out to the shareholder as a dividend. I will read out the important key takeaway of a dividend. A dividend is a distribution of the corporate earning to the eligible shareholders. The dividend payments and the amount are determined by the company's board of directors. The dividend yield is the dividend per share and expressed as a percentage of the company share price. Many companies do not pay dividend and instead retain earning to be invested back into the company. Moving on to the topic number 2, the type of dividends. There are various type of dividend a company can pay to its the shareholders, like the cash dividend, stock dividend, stock repurchases, the property dividend, scrip dividend, the qualitating dividend, liquidating dividends, qualified dividend, special dividend, and the interim dividend. In this video, we are going to discuss only on the cash dividend and the stock dividend. Now we can see what is a cash dividend. A cash dividend is a distribution of fund or the money paid to the shareholders, generally as a part of the corporate current earning or the accumulated profit. The cash dividend are paid directly in money as opposite to being as a stock dividend or the other form of value. The stockbroker offers a choice to reinvest or accept the cash dividend. I will read out the key takeaway of the cash dividend. A cash dividend is a payment made by the company to its shareholder in the form of periodic distribution of cash. The cash dividend are often paid on a regular basis, such as monthly or a quarterly, but are sometimes one-time only payout, such as after a settlement. Most brokers offer a choice to accept or reinvest the cash dividend. Dividend paying companies are typically established with the stable cash flow and beyond the growth stage. The dividend reinvestment plan are increasingly common among the company and the brokers. Just take an example. Let's say you own the 50 shares of ABC company and you bought them for 200 apiece for the total of rupees 10,000. Since the company declare 5% per share dividend, you will receive rupees 10 as a cash dividend, which will be paid to all the shareholders. So your total dividend value would be rupees 500. If the company declared the same quarterly cash dividend each quarter, that equates to rupees 2000 cash dividend received for the year, assuming you still own only 50 shares of the company. Now we can see what is a stock dividend all about. A stock dividend is a payment to the shareholders that consists of additional share rather than the cash. The distributions are paid in the fractions per existing shares. I will read out the key takeaway of the stock dividend. A stock dividend is a dividend paid to the shareholders in the form of additional shares in the company. The stock dividend are not taxed until the shares are sold by their owner. Like the stock split, the stock dividend dilute the share price because the additional shares has been issued. They do not affect the value of the company as well. The company may prefer to pay the dividend in the stock rather than the cash in order to preserve its cash reserve. Just an example, let's say you own 1000 shares of ABC company and you bought them for 20 rupees a piece for the total of rupees 20,000. If a company issued a 5% stock dividend, your share would be increased by 5%. If you previously had 1000 share in the company, you would now have 1050 shares in your portfolio. Let us discuss some of the major difference between the stock dividend versus stock split. A stock dividend means the dividend which is paid in the form of additional shares, whereas the stock split is a division of the issue shares in the ratios as decided by the company. In the stock dividend issued from the free reserved, whereas the stock split only increase in the number of shares and no changes in the value of issue shares. The main reason for the stock dividend is due to the shortage of the cash flow in the company, whereas the main purpose for the stock split is for reducing the market price of the shares. There is a journal entry passes for the stock dividend, that is debiting the reserve and crediting the issued share capital, whereas no journal entry is passed in case of stock split, only the details are mentioned in the issued share capital. In the stock dividend, existing shareholders are allotted additional shares, whereas the shares which are already held are divided. There are no type of stock dividend available in the stock market, whereas there are two type of stock split available in the market. The first one is a forward stock split, the second one is a reverse stock split. Moving on to the topic number 3, how often are the dividend distributed to the shareholders? What is an interim dividend? An interim dividend is a dividend payment made before the company's annual general meeting and the release of the final financial statement. This declares the dividend usually accompanies the company internal financial statement. The interim dividend is issued more frequently in India, where the dividends are often paid semi-annually. The interim dividend is typically the small of the two payments made to the shareholders. I will read out the key takeaway of the interim dividend. An interim dividend is typically one of the two dividends given out by the company that is provided shareholder with income of the semi-annual basis. The interim dividend is usually paid out ahead of the firm annual general meeting and the release of the final version of its financial statement. The final dividend are paid out after the release of the final version of the company's final statement. As a result, the final dividend are paid from the current earning and the interim dividend are paid from the retained earnings. The company's board of directors is responsible for declaring an interim dividend, but whether it's approved or not is up to the shareholders. What is the final dividend? A final dividend is declared at the company's annual general meeting for the given fiscal year. This amount is calculated after all year-end financial statements are recorded and the director are made aware of the company's profitability and the financial statement. This is a different than the interim dividend, which is made before the company's final financial statement are known, audited, and released. I will read out the key takeaway of the final dividend decided and declared at the company's annual general meeting for a given fiscal year. A final dividend is based on the picture painted by the year-end financial statement. The final dividend is generally a large payout than the interim dividend offered by the company at other time of the year. A final dividend is not to be confused with the liquidating dividend, the last payout issued to the shareholder when the company is closing down, significant shrinking, or being acquired. What is the key difference between the interim dividend and the final dividend? An interim dividend is paid before the final result for the financial years are announced, while a final dividend is paid after the results are announced. The interim dividends are usually declared by the board of directors, whereas the final dividend are declared by the shareholders. The interim dividend are typically paid to provide the shareholders with the return on the investment while they are waiting for the final results, while the final dividend are paid as a reward for the remaining shareholders through the end of the financial year. Interim dividend are usually smaller than the final dividend as they are paid out before the company's financial results are known. Interim dividends are paid out of a current year profit, whereas the final dividends are paid out of a accumulated profit. Interim dividend may have a little impact on the share prices, whereas the final dividend may have more impact on the share prices. What is a special dividend all about? A special dividend is a non recurring distribution of the company asset, usually in the form of cash to the shareholders. A special dividend is usually larger compared to the normal dividend payout by the company and is often tied to the special event like an asset sale, corporate restructuring, spin off, or the other windfall generated events. Special dividend are also referred as an extra dividend. I will read out the key takeaway of a special dividend. A special dividend is a non recurring distribution of a company asset, usually in the form of cash to the shareholders. Most special dividends are larger than the normal dividend paid to the shareholders and are tied to the certain events. Special dividend can also recur when the company wishes to make the changes to its financial structure or the spinning off a subsidiary company to its shareholder. Most companies don't make more than one special dividend in their history. The boon to the investor, the special dividend have some drawbacks such as the reduction in the share prices and sometimes the prescriptions of the company lacking in the growth potential. Moving on to the topic number 4. What is a dividend yield? Dividend yield is a ratio that shows you how much income you earn in the dividend payout per year for each rupees invested in a stock, mutual fund, or the exchange traded fund, that is ETS. To put it another way, the dividend yield is the security's annual dividend payment expressed as a percentage of its current price. This percentage yield tell you what your annual earning on the investment you would be the price you paid for the security. How to calculate the dividend yield? To calculate the dividend yield, divided the total annual dividend amount of a stock or a fund in rupees by the price per share. The dividend yield equals to dividend per share divided by the price per share. Let's say a public company share price is 50 and its pay the annual dividend equals to 1.5 rupees per share. To determine the dividend yield, divided the dividend amount per share by the price per share. That is 1.5 rupees divided by 50 rupees. It gives you 0.03. Convert the decimal to the percentage and you get a dividend yield of 3%. That means you would earn 3% in dividend per year for the investment in the company's stock at this price, assuming the dividend payout remain unchanged. What affects the dividend yield? There are many factors that impact the dividend yield, like the overall market condition, individual stock, and the fund prices and the company performance. Let's see few of them. Stock price. The biggest factor impacting the dividend yield is the company's stock price. When the share price rises, the dividend yield fall unless the company chooses to boost the dividend payout. Industry trend. When evaluating the dividend yield, it is important to compare the yield offered by the company in the same industry or the fund in the same category, since the yield are vary greatly across the sector, industry, and the fund category. Company growth. Generally speaking, the older, the larger company that are well established and have the steady performance are more likely to pay the dividend and have the higher dividend yield than the new and the small company. Company fundamental. High dividend yield can be attractive, but sometimes they can be the sign that a company is facing a problem. A high yield can occur when the stock price falls due to the decrease in the company earning or become the declining investor sentiment. What is a good dividend yield? Yield from 2% to 6% are generally considered to be a good dividend yield, but there are plenty of factors to consider when deciding if a stock yield make it a good investment. Your own investment goal should also play a big role in deciding what a good dividend yield is for you. If you are retired or you are approaching a retirement age, you may be looking for a built a portfolio of income generating assets. Investors in this camp prefer dependable, sustainable dividend yield for the long term. Moving on to the topic number 5. These are the list of high quality dividend paying stock in the Indian stock market. Moving on to the topic number 6. What are the important dividend dates? Dividend payments follow a chronological order of events, and the associated dates are important to determine which associates qualify to receive the dividend payment. Declaration date. This is the date on which the board of directors announced to the shareholder and the market as a whole that the company intend to pay a dividend. On this day, the company provide the three dates that pertaining to the payout. Ex dividend date. This is a single most important date in the dividend investing world. On or after the ex dividend date, a stock no longer come attached with the right to be paid the most recent declared dividend. In other words, you must purchase a stock before its ex dividend date to receive it the next scheduled dividend payout. The ex-dividend date is important for the company as well because it makes the reconciliation of who is to be paid the dividend easier. Prior to the ex-dividend date, the stock is said to be a cum dividend. Existing holder of the stock and anyone who buy it will receive the dividend, whereas any holder sell the stock lost their rights to the dividend. On and after this date, the stock become the ex-dividend. Existing holder of the stock will receive the dividend if they now sell the stock as well. Whereas anyone who now buy the stock now will not receive the dividend. In almost all the cases, the ex-dividend date fall 2 days before the record date. Record date. This is the date on which the company physically looking of its record to see who the shareholder of the companies are. The shareholder who properly register their ownership on or before the date of record will receive the dividend. Shareholder who are not registered as of this date will not receive the dividend. Registration in most countries is essential automatically for the share purchases before the ex-dividend date. In almost all the cases, the record date fall 2 business days after the ex-dividend date. If you buy after the record date, you won't receive the dividend at all. Payment date. The payment date, also known as the payable date, is the day when the dividend check will actually be mailed to the shareholder of a company or credited to the brokerage account. This date may be the several days after the date of record so that the company can accurately confirm the payout to the shareholder of the record. Once again, see the chronological order of the important dividend dates. Moving on to the topic number 7, how to plan dividend stock purchases. How to plan its purchase by keeping a past record of the company which has paid the decent dividend. This will be your the list of highest dividend paying stock. Net profit. This is the profit earned by the company after paying all the dues like adjusting for the depreciation, interest, tax, etc. Dividend paid. Here we will have to compare two things. Out of the total paid, how much lump sum dividend the company has paid. Dividend payout percentage. Dividend payout suggested what portion of the paid was paid out as a dividend to the shareholder. Record keeping of the dividend payout percentage will give you a good insight. The good company tried to mimic the past dividend payout ratio. Moving on to the topic number 8, why companies pays the dividends. Successful companies are profitable companies They earn money and they can use that money in the several ways. Reinvested. The company usually invests a good chunk of their profit, if not all of them, into the growing the business. Pay down the debt. If, in addition to selling the shares, company borrowing money to raise capital, they may use the profit to pay down the debt, thereby reducing the expenses of their interest payment. Buy back shares. Company may use the profit to buy back the shares that they feel are undervalued or for other reasons. In some cases, they initiate the buyback of the artificially inflate the share price and improve the investor confidence in the company. Pay dividends. Paying dividend is a form of profit sharing, spreading the wealth among the company's owner, the shareholders. A company dividend policy generally reflects the board of director and the shareholder preferences in how to use the profit. Two school of thought govern the decision. Pro growth. This school believes a company is better off reinvesting its profit or using the profit to pay out the debt or buy back the shares. This strategy makes the company more valuable and the share price rises accordingly. The shareholder benefited when they sell their share for more than they paid for them. Pro profit sharing. This philosophy stems from the belief that the shareholder owns the company and should share its profit. Moving on to the topic number 9, the advantages of dividend investing. Receiving dividend is like collecting interest on the money in a bank account. It is very nice but not exciting. Betting on the rise and fall of a share price is much more exciting, especially when your share price soars. Placing the excitement to the side, however, the dividend stock offer the several advantage over the non-dividend stock. Let's take one by one. Passive income. Dividend provides a steady flow of passive income which you can choose to spend or reinvest. This attribute makes the dividend stock particularly attractive to retrieves looking for the supplementary income. More stable company. Company that pay the dividend tend to be more mature and stable than the company that don't. Startup rarely pay the dividend because they pour back all the profit to the fuel their company. Only when the company has attained a sustainable level of success does it the board of directors vote to pay the dividend. In addition, they need to pay the dividend tend to make the management more accountable to the shareholder and less prompt to take the foolish risk. Reducing risk. Because the dividend gives the investor two ways to realize the return on their investment, they tend to have the low risk to reward ratio when you can see in the less volatility in the share prices. A stock will low volatility see the smaller share price decline when the market fall. The low volatility may also temper the share price appreciation on the way up. Two-way to profit. With the dividend stock, your return of investment increase when the share price rises when the company pay the dividend. With the non-dividend stock, the only way you can earn the positive return is through the share price appreciation, buying low and the selling high. Continued ownership while collecting the profit. One of the most frustrating aspects of owning the share of the company that doesn't pay the dividend is all the profit are looking in your stock. The only way to access those profit is to sell the shares. With the dividend stock, you retain the ownership of the company while collecting the shares of its profit. Cash to buy more shares. When you buy X number of shares of the company that does not pay the dividend, you get X number of shares. If you want more shares, you have to reach out into your pocket to pay for them. With the dividend stock, you can purchase additional shares by reinvesting all or some of the dividend. With the dividend stock, you can purchase the additional share by reinvesting all or some of your dividends. You don't have to reach in all to your pockets second or the third time. In most cases, you can even enroll a special program that automatically reinvests your dividends. Hedge against the inflation. Even a modest inflation rate can take a chunk out of the earning. Earn a 10% of return, subtract 3% from inflation, you are down by the 7%. Dividend may offset the losses. As the company charge more for the product, they also tend to earn more and pay the higher dividend as a result. Positive return in the bear market. In the bear market, when the share prices are flat or dropping, the companies that pay the dividend typically continue paying the dividends. This dividend payment can help to offshore any losses from the drop in the share price and may even result in the positive return. Potential boost from the baby boomers. As more baby boomers reach the retirement age and seek source of supplementary income, they are likely to increase the demand from the dividend stock, driving up the price. Nobody can predict with any certainty that will happen. Moving on to the topic number 10, the risk. There is no such thing as safe investing, only the safer investing. You can lose money in any of the following ways. Share price can drop. This situation is possible regardless of whether the company paid dividend. Worst case scenario is that the company goes belly up before you have change to sell your shares. Company can trim or slash dividend payment at any time. Company aren't legally required to pay the dividend or increase the payment. Unlike bond, when failure to pay the interest can put a company into default, a company can cut or eliminate a dividend at any time. If you are counting on the stock to pay dividend, you may view a dividend cut or eliminate as a losing money. Most companies try their best to avoid this move because cutting the dividend may cause the shareholders to sell lower the share price. Inflation can nibble away at your saving. Not investing your money or investing in something that doesn't keep pace with inflation cause your investment capital to lose the purchasing power. With inflation at work, even the rupees you scramble and save it worth or worthless. Moving on to the last topic of the video, that is topic number 11, the TDS on your dividend income. You can effectively avoid or minimize the TDS on your dividend income and benefit fully from your investment return. Let me walk you through some of the point. If your total dividend income is less than 5,000 in a financial year, then the TDS will not apply to your interest income received. You can submit the form 15G, 15H to the company or the mutual fund declaring that your total income for the financial year is below the taxable limit. The TDS should not apply to your dividend income. If you have invested in the tax-free bond, you have no TDS will apply to the interest income received. You can invest in the growth mutual fund instead of the dividend mutual fund to avoid TDS. If you fall under the low tax bracket, then you can declare your dividend income in your tax return and claim the refund for the TDS deduction. That's it for the video. You should take your time to understand all the concepts discussed in this video. Take your notes and go back from time to time to review the strategy which has been shared with you. Please subscribe to our channel and click on the bell icon to get all the notification for our upcoming videos. Please like the videos and provide your comments if any. If you think that the content of this video are knowledgeable, then please share this video with your colleagues and friends. Once again, thank you for watching the entire video.